Hello everyone and welcome to another video with Nadal Rashid, and today we're going to be running the numbers on a project that we have been working on here in Marleston in Adelaide. Now, due to some requests from some clients and people I work with, they've asked me to do an overview of the numbers because this project has been quite popular. So we've had a lot of investors showing interest, and I thought I'd just run through just the high level numbers to give you guys an idea of what kind of investment potential this property will have. So the property that we're going to be discussing today is actually 12 Cudmore Terrace in Marleston. So for those of you who know where that is, it's approximately between Adelaide CBD, the beach and the airport. So luckily it's not in the flight zone, so we're covered in that. It's just off Richmond Road. So if you were coming down Richmond Road away from the city, you'd be turning left onto Cudmore Terrace, and just down here you'll see the existing dwelling, but that's already been demolished and they've started site works on the property this week. So well and truly underway, and looking at handover for this project in May at this stage. So the developer that we worked with, ADGS, have always delivered ahead of schedule, so I don't see why there'd be an exception in this case. So for those who are looking at something that's going to be built, turnkey, fixed price, ready to move into upon completion, this will be a perfect project to look into. So in terms of Marleston, location wise, you guys know it's within a short proximity to the city. So you're looking at less than 5 k's out of the city. You're looking at close proximity to shops, schools, hospitals, the beach, the airport. So really does tick a lot of boxes in terms of the amenities and the services that are nearby. I won't go into all the details, but just as a high level, I can tell you that Marleston has increased by over 20% in capital growth just in the last 5 years, and the gross rental yields in there at the moment are sitting at 4%. In fact, as a company, we're offering a rental guarantee at 4%. So anyone who invests in this project and uses Silvertail property management will automatically get that benefit. Now, in terms of the features, I won't go through everything, but I can tell you that they're going to be high level and high specifications. So we're talking 2.7 meter high ceilings, 2.4 meter high doors, tiling to the ceilings. I believe they're using Calcutta tiles, which is premium selection, stone bench tops, LED lights, reverse cycle ducted aircon. We've even got, as a special upgrade, Holland blinds to the whole house, as well as a security system. It's going to have matte black tapware all the way through. So it really does tick all the boxes for those who are looking at something either as an owner-occupier or as an investor. So if you're looking at utilizing the first homeowners grant as well as the home builder grant, this certainly qualifies because it's gone to construction after June 4th. As long as you enter into a building contract before December 31st, you'll be entitled to that $25,000 home builder grant. So obviously it's subject to eligibility, but that's something that we can discuss further at a later date. So this is just basically high level information on this, and I'm happy to send this out to whoever wants to take that up. Now, in terms of the site plan, there's going to be 3 dwellings. They're all going to be 3 bedroom, 2 bathroom, single garage with another car space. It'll have an alfresco under the main roof. So if I take you through one of the floor plans, I mean, as you walk in, you've got a study on the entrance, and then there's a door leading into the garage. There will be a French style laundry in the corridor, with a linen cupboard to the side. It's going to have a separate bathroom and a separate toilet. Bedrooms 2 and 3 will have their own built-in robes. Bedroom 1 will have a walk-in robe and its own ensuite. And then you've got an open plan for the kitchen, dining, family, as well as an alfresco under the main roof. So we're talking 162 square meters of building, and there's 222 square meters of land. There's slight variations to each one. Obviously with the selections, you can opt for either a cool or a warm color scheme, which will apply throughout the whole house, and that's something that we can help guide you on as well. So jumping into the numbers side of it, I'll just go into my calculator. What I've done is I've basically broken it down into 3 sections, which is the capital expenses, the annual income and expenses, and tax and market factors. So Being that the purchase price is at 560, we've just put in 560 as the purchase price and market value. Due diligence costs, I mean, we always recommend getting a building inspection, even though it's a brand new home. You want to know what the state of the property is when you receive the keys. So if there's any defects or anything, we can obviously rectify those. In terms of your settlement costs, I've assumed a 10% deposit in this case, so a 90% loan. Obviously, that can vary from client to client and from one circumstance to the next. But for the sake of this example, I'm going to work with 10% as a deposit. Stamp duty is calculated on the completed price and on a completed project, as this is going to be done as a 1090 setup, whereby you pay 10% deposit up front, and then the balance is only due after it's been completed and finished being built. So because you're settling on a property once it's completed, you're paying stamp duty on a total amount, whereas with house and land, you obviously pay only on the land. The benefit with this though is that you don't have any holding costs. So whilst the house is getting built, you're not making any payments to the bank or making repayments on the interest. In terms of legal fees, I've allowed $1,000 in there. That's for your conveyancing. Generally speaking, you're going to be paying about $600 to $800, but I've just allowed a little bit extra. In terms of the loan costs, depending on whether you take up a package or not, you could be up for about $400 as a package fee. Seeing that this is a 10% deposit and a 90% lend, I've allowed some LMI in there. I've just taken the estimate from the calculator in here. In terms of the improvement and selling costs, there are zero. I mean, you don't need to put any money on improving the property. It's going to be brand new. You don't need to do any renovations or any extensions or anything like that. So this part is not applicable. However, your selling costs, if you decided to sell this property down the track, I've allowed 2.2% for an agent's selling commission, as well as $3,000 for advertising, as well as $1,000 for legal fees. So what this will do is we'll calculate our exit costs if you decide to sell at any point. Now, the second section is the annual income and expenses. So this is broken down into 3 subsections. Number 1 being the rental income. Now, we've given a rental guarantee at 4%, which works out to be at least $430 a week. But we know that we're obviously going to be around that $460 per week. That's what the rental estimates are showing us. And that was done at the time that we first marketed the property. So the rental market's obviously changing at the moment. We expect that this figure will be more by the time that the house is completed, and we're looking, pricing is probably going to be closer to the $480 per week. But in this example, let's just work off $460, keep it conservative. I've also allowed 2 weeks vacancy every year as well. So 2 weeks without rent has been factored in, and that will obviously show us how much rental per annum we can expect from this property. Now, in terms of the property expenses, which is the second subsection, now this breaks down our yearly costs. So in this case, I've allowed $1,400 a year in council rates, so $350 a quarter. Seeing that this is a Torrens titled property, it's a small block, it's obviously calculated on the land value. Now, the land tax I've kept blank because this is dependent on your situation in particular. So if you own multiple properties in South Australia and you're looking at this as an investment, it might be worthwhile having a chat to your accountant to see if there's another structure you can purchase this under. The third cost down is your building and landlord insurance. So we've allowed $1,000 a year for this particular property. Now, seeing that it's a Torrens title, there's no body corporate or strata or anything that's applicable. Repairs and maintenance are going to be also very minimal because it's a brand new property. There's not going to be any maintenance costs or repairs, especially in the first few years. So it's a brand new property, so everything's under warranty initially. Again, there's no cleaning contracts or service contracts or garden and lawn maintenance. You're renting out a house as is, and it's expected that the tenants will look after the upkeep. In terms of your fees that you incur, there will be a 1 week's letting fee. There are some SA water charges, so this is just for your supply. It's obviously less than $400 a year, but I've allowed that in there anyway. And for property management, I've just kept the standard rate of 8.8%. Now, in terms of the loan and interest components, we have done this as just an interest only. I can go back and show you the principal and interest, but for the sake of this example, I'm using an interest only scenario where the loan is stretched out over 30 years and we're borrowing 90% of the property's value. So we're borrowing $504,000 in this example. Now, the loan interest rates at the moment are a lot less than 3%. So, you can get interest rates for as little as 2%, 2.2, 2.3, 2.4, 2.5. So it does vary on a wide range of variables. But in this case, I've allowed 3%, which should be quite conservative given the climate that we're in at the moment. So this is our income and expenses. Our third section is the tax and market factors. And what this does is it calculates our tax benefits. So in this case, we've got depreciation, which is the obvious one. Because it's a brand new property, all the fixtures and fittings in there are depreciated on paper, which means as your tenants start to use the carpets and the aircon and the blinds and the appliances, all of those depreciate on paper. That depreciation amount comes off your taxable income. And I'll show you how that plays out in the figures. The second subsection is the market factors, and that factors in the average or the forecasted capital growth. Now, keep in mind that this is speculation, so nothing is obviously guaranteed, but when you compare, what we've forecasted in growth in comparison to what has actually happened in Adelaide or South Australia over the last 100 years, this is a pretty conservative amount. Usually they say property doubles every 7 to 10 years. In this example here, you'll see it doesn't even double in that 10-year period. The other factor is the CPI. So every year costs and the cost of living increase. So we've factored that in and we've put it in, and that's already programmed at 3%. And then the last section is the taxable income. Now this depends on your situation and how much income you earn. So I've based this on the average client that we work with generally earns about $80,000 a year, and they're in that 32.5 cents or 32.5% tax bracket. So when we look at how a property comes into it, you'll see that there's really good ways to reduce your taxable income by investing in this asset class. So when we look at the forecast, now this property that we purchased in 2020 for $560,000 over a 10-year period with a 5% capital growth, we're saying that it's going to go from 560 to 912. So if we work out the uplift, that's about 350 grand over a 10-year period. If you average that out over the 10 years, that's about $35,000 a year that you're getting in equity uplift that you're not really having to do anything for. So you're not having to physically improve the property or do anything with it. This is purely a buy and hold. Now the loan amount, in this example, because we've done it on interest only, you'll see that the loan actually stays the same all the way through. So in this example, the loan doesn't go down, but as the value goes up, the LVR, which is the loan to value ratio, starts to decrease. So when you first start off, you're starting with a 90% LVR. In the second year, you're going to be down to about 86% LVR. By the third, you're at 82, and so on and so forth. So if you fast forward 5 years down the track, you got this property that's worth $714,000, you owe $504,000 against it, you got a 71% LVR, meaning you got $210,000 worth of equity in this property. However, you can't use that whole 210 because the bank wants to retain some security. At a 90% LVR, you'll be able to work with about $139,000. So that's what you would be looking at obviously using as a deposit for the next property purchase. Now the income side of it, based on that $460 rent per week, this property is going to generate $23,000 worth of rental income for the year, which is a 4.1% gross yield. It's going to work out to 3.2% net after tax. So when we look at the expenses, the interest rate being at 3% means that we've got about $15,120 worth of property expenses, interest expenses over the year. And the property expenses, being your rates, your insurance, your property management, and all these other fees, comes to $5,304. So when you add those two expenses together, you're going to have about $20,424 going out, and you've got $23,000 coming in. So what that means is before tax, this property is going to be positive cash flow by $2,500 a year, which equates to $50 per week. However, it doesn't stop there, because if this was an older property, you'd have to pay tax on this money. But because it's a brand new property, you don't have to pay tax on that because we've got depreciation. So where we first started, we had $12,755 worth of depreciation in the first year. We can't actually use all that because now we've made a profit. So we take the profit out of our deductions, And because we also had some other deductions in terms of LMI, you can claim that over the first 5 years. All of your costs that are involved with the property, so things like your building inspections and any fees and things like that, that's all costs that you can reduce your taxable income by. So by the time we add all of them up, we've got a net loss of $11,922 on paper. Right? Keep in mind, we've made a $2,576 profit or cash flow from this property. However, we're still claiming $11,922 in losses. So when we take that off someone who's earning $80,000 a year, when we take that off their taxable income, you'll get a estimated tax refund of $3,875. So that's how much you would get back after tax. So the after-tax cash flow is $3,875. The pre-tax cash flow is $2,576. So that means your total cash flow is $6,451 positive per year, which equates to $124 a week. So let's recap. There's three things that have happened here. Firstly, we've got a property that's increasing by $35,000 a year in capital growth. Secondly, we're making a pre-tax cash flow. So before you've even done your tax return, you're getting a positive cash flow of $2,500 a year, and you're also saving an additional $3,875 on your tax, which means that the cash flow out of this is going to be close to $6,500 a year. So for those of you who know about our system, we generally target three main areas: capital growth, rental yield, and tax effectiveness. And in this case, this property ticks all three boxes for us. It's in a great location. It's a great builder. In fact, the builder has been awarded only recently. It's actually going to be with Batillo Construction, which we've done a bit of work with in the past, and they build quality homes. And you know, we haven't been able to fault them in terms of their process and their build. So we're happy to recommend them. We're happy to recommend the developer as well, ADGS. This is our fourth project that we work on together. So they've always delivered ahead of schedule. They've they obviously operate with integrity. Otherwise, we wouldn't work with them. And based on everything that we've seen and gone through, this definitely ticks the boxes. Happy to recommend it. And anyone who's looking at investing and wants something that's going to be close to the city, closest thing you can get to a blue chip type investment in the property world, this is it. So if you'd like to find out more, feel free to reach out, give us a buzz, and we'll be happy to help out. All right, chat to you soon. All the best.